Before we begin, a quick and important disclaimer. The content in this video is for educational and informational purposes only. It should not be construed as financial, legal, or tax advice. I am not a licensed financial advisor, and this presentation is not a solicitation to buy or sell any securities. Investing involves risk, including the potential loss of principal. Always conduct your own thorough research and consult with a qualified professional before making any investment decisions. Let's be honest. You've been told your entire life that real estate is the key to wealth. That 90% of the world's millionaires built their fortune through property. You see it on TV shows, you hear it from that one uncle at Thanksgiving, you read it in books. Buy land, they say. They're not making it anymore. And it sounds incredible, right? The idea of owning a tangible asset, a piece of America, that generates cash flow every single month while its value climbs higher and higher. It's the American dream, packaged in drywall and a white picket fence. But then reality hits you like a ton of bricks. Or more accurately, like a ton of unexpected plumbing bills. You start looking at the numbers. The down payment for a decent single-family home in a good neighborhood? In many U.S. cities, you're looking at $100,000, $200,000, more, just to get in the door. It's a staggering amount of capital to tie up in one single asset, in one single location. And let's say you manage to scrape together that mountain of cash. Congratulations! You're now the proud owner of a second job you can't quit. You're not just an investor. You're a landlord. You're a property manager, a plumber, a roofer, a debt collector, and a part-time therapist for your tenants. You're the one getting the call at 2 in the morning because a pipe burst. You're the one chasing down rent from a tenant who suddenly forgot how to pay. You're the one spending your weekends painting walls, fixing leaky faucets, and dealing with the homeowners association because someone's grass is a quarter inch too long. This isn't passive income. This is active, stressful, all-consuming work. And the risk? It's all on you. If that property sits vacant for 3 months, you're still on the hook for the mortgage, the taxes, the insurance. That's negative cash flow bleeding directly from your bank account. If the local economy takes a nosedive because a major employer leaves town, the value of your one property could plummet. You have all your eggs in one very expensive, very demanding basket. It's enough to make anyone throw their hands up and say, "Forget it. I'll just stick to the stock market." It feels like the real estate game is rigged for people who are already rich, people who can afford to buy a dozen properties and hire a team to manage them. For the average person, the dream of building wealth through real estate feels just like that. A dream. But what if I told you there's another way? A way the wealthy have been using for decades to get all the benefits of real estate investing. The appreciation, the cash flow, the inflation hedge, without any of the soul-crushing headaches. What if you could own a piece of 100 properties instead of just one? A piece of a luxury apartment building in Austin, a cutting-edge medical office in San Diego, a massive e-commerce warehouse outside of Chicago, and a portfolio of single-family homes across the Sun Belt. All at the same time. What if you could do it without ever screening a tenant, fixing a toilet, or answering a single late-night phone call? And what if you could get started not with a $100,000 down payment, but with an investment that's far more accessible? This isn't a fantasy. This is the power of a real estate fund. And that is exactly what we're going to demystify today. We are going to pull back the curtain on one of the most powerful, yet often misunderstood, tools for building wealth in real estate. This video is your simple, no-nonsense guide for U.S. investors. We're going to break down, in plain English, what a real estate fund is, how it actually works, the critical differences between the types of funds out there, the massive advantages they offer, and just as importantly, the risks and downsides you absolutely need to be aware of. By the end of this, you'll understand the mechanics of how you can become a fractional owner of a massive, diversified, professionally managed portfolio of properties. Think of it like this. You wouldn't try to build a diversified stock portfolio by just buying one single share of one single company, would you? Of course not. It's incredibly risky. You buy a mutual fund or an ETF which pools your money with other investors to buy shares in hundreds, or even thousands of different companies. It's instant diversification, managed by professionals. A real estate fund is the exact same concept but for property. It's a professional investment vehicle that pools capital from a group of investors, people just like you, to go out and buy, manage, and sometimes develop a portfolio of real estate assets. You're not buying a whole building. You're buying a share of the fund that owns the building, and the office park, and the shopping center, and the apartment complex. The fund's management team, a group of seasoned real estate experts, handles everything. I mean everything. They find the deals, they perform the due diligence, they negotiate the purchase, they secure the financing, they manage the properties, they collect the rent, and they handle the eventual sale. Their entire job is to operate these properties to generate cash flow and increase their value. And you, as an investor in the fund, get to reap the rewards. You receive your pro rata share of the rental income, typically paid out in distributions, say on a quarterly basis. And when the fund sells a property for a profit, you get your share of those gains too. You get the financial upside of being a property owner, while outsourcing all of the work, all of the stress, and all of the expertise to a team of professionals. This single shift in strategy, from being a direct, hands-on landlord to being a passive investor in a fund, is what separates the amateurs from the pros. It's a fundamentally smarter way to approach real estate investing for the vast majority of people. It's about achieving diversification you could never achieve on your own. Imagine your one rental house has a vacancy. Your income for that property drops to zero. Now imagine you own a piece of a fund with 500 rental units. If one of those units is vacant, it's a tiny, insignificant blip on the overall portfolio's performance. That is the power of diversification. It's a shield that protects you from the concentrated risk of owning just one or two properties. It's also about access. These funds are playing in a different league. They aren't competing with you for that 3-bedroom house on Zillow. They're buying institutional-grade assets, the $50 million apartment complexes, the $100 million industrial parks, properties that are completely inaccessible to the individual investor. These are often higher-quality assets in prime locations with better tenants and more stable returns. A fund gives you a ticket to that exclusive game. So if you've ever felt frustrated by the high cost and hassle of traditional real estate investing, or if you're looking for a way to add the stability and growth of real estate to your portfolio without the headaches, you are in the right place. We're about to dive deep into the engine room of how these funds work, and it's going to change the way you think about investing in property forever. So let's pull back the curtain. At its core, a real estate fund is a masterclass in teamwork. It's the ultimate financial potluck. Imagine you want to host a huge banquet, a feast with dozens of incredible dishes, but you only have the time and money to make one casserole. On your own, the banquet is impossible. But what if you invite 100 other people, and each person brings one dish? Suddenly, you have a spectacular feast that no single person could have created alone. A real estate fund operates on this exact principle: the power of pooling resources. Instead of dishes, we're talking about investment capital. And instead of a banquet, we're talking about a portfolio of large-scale, high-potential real estate assets, the kind of properties that are typically out of reach for individual investors. We're talking about 100-unit apartment complexes, sprawling shopping centers, state-of-the-art medical office buildings, or even massive industrial warehouses that power our e-commerce economy. A single investor might have $50,000, $100,000, or even $250,000 to invest. That's a lot of money, but it's not enough to buy a $20 million apartment building in a booming Sunbelt city. But when 200 investors pool their $50,000 each, they suddenly have $10 million. That $10 million is the down payment, the equity that allows them to go out and acquire that $20 million asset, with the other $10 million financed by a bank. Suddenly, every single one of those investors owns a piece of a massive income-producing property. They've gone from making a casserole to owning a share of the entire banquet. That is the foundational magic of a real estate fund. It's a vehicle that democratizes access to institutional quality real estate. Now, a potluck this big needs a coordinator, a chef to run the kitchen. In the world of real estate funds, this expert coordinator is called the sponsor, or the general partner, often shortened to GP. This is the most important person or company in the entire equation. The GP is the seasoned real estate professional. They are the ones with the deep market knowledge, the network of brokers to find off-market deals, the relationships with lenders, and the operational expertise to manage the properties effectively. They do all the heavy lifting. They find the deal, they perform months of painstaking due diligence, they negotiate the purchase, they secure the financing, they oversee the renovations, they manage the property, and ultimately they execute the sale. The GP is the captain of the ship, the quarterback of the team. Their entire business is dedicated to making the investment successful. They are putting their reputation, and often a significant amount of their own money, on the line. And who are the other people on the ship? The ones who brought their capital to the table? You, the investors. In this structure, you are called the limited partners, or LPs. Your role is beautifully simple: you provide the capital. And in return for that capital, you get to be a passive owner. You are a partner in the deal, but you are a limited partner. This limited part is critically important. It means your liability, your financial risk, is limited to the amount of money you invested. If something goes wrong at the property, a major lawsuit, for example, the creditors cannot come after your personal assets. They can't touch your house, your car, or your retirement savings. Your investment is protected within the fund structure. You get all the upside of ownership, the cash flow, the appreciation, the tax benefits, without the soul-crushing downside of unlimited liability and the day-to-day headaches of being a landlord. No calls about broken toilets at 3 a.m. No chasing down tenants for late rent. No hiring contractors. You are the silent partner, the passive investor, leveraging the GP's expertise to build your wealth. This whole partnership, this agreement between the general partner and the limited partners, is formalized within a legal structure, most commonly a limited liability company, or an LLC. Think of the LLC as a strongbox. The general partner creates this strongbox for a specific investment or a group of investments. The limited partners place their investment capital into the strongbox. The properties the fund acquires are also placed inside this strongbox. The LLC owns the real estate, and you, the LP, own a percentage of the LLC. This legal container separates the investment from everyone's personal financial lives, creating that protective wall we just talked about. It's the legal framework that makes this entire passive, protected, and powerful investment possible. So, with the players and the structure in place, what does the actual journey of an investment look like? It typically follows a clear 5-act story. Act 1 is the capital raise. The sponsor, our GP, identifies a compelling opportunity. They might find an underperforming apartment complex in a city with massive job growth. They see a clear path to increase its value. They develop a detailed business plan. We will buy this property for X, spend Y on renovations over 24 months, increase rents by Z, and sell it in 5 years for a projected profit of A. This entire plan is packaged into a legal document called a Private Placement Memorandum, or PPM. This is the rulebook for the investment. The GP then presents this opportunity to investors, the LPs, to raise the necessary capital, the down payment to buy the property. Act 2 is the acquisition. Once the money is raised from all the LPs, the fund closes and the GP goes to work. They execute the purchase of the property. This isn't just signing a check. It's an intense period of final due diligence, where they walk every single unit, inspect the plumbing, the electrical, the roof, and review every single line item of the property's finances to ensure there are no hidden surprises. Act 3 is the value add. This is where the sponsor truly earns their keep. They execute the business plan they sold you on. If it's an apartment building, this is where the transformation happens. The old, dated lobbies get a modern makeover. The 1980s style kitchens with laminate countertops are replaced with granite and stainless steel appliances. A new coat of paint goes on the exterior. Maybe they add a dog park, a fitness center, or an outdoor grilling station. They are actively forcing appreciation. They aren't just buying a property and hoping the market goes up. They are physically improving the asset to make it more desirable, allowing them to attract better tenants and increase the rental income. This strategic improvement is the engine of profit growth in most real estate funds. Act 4 is the operation and cash flow. While all these improvements are underway, the property is still operating. People are living there, paying rent every month. This rental income is used to pay the mortgage, the property taxes, the insurance, and all the operating expenses. What's left over is the net operating income, the profit. A portion of this profit is often distributed to you, the limited partners, on a regular basis, typically every quarter. This is your passive income. It's the cash flow you receive simply for being an owner, while the GP manages the day-to-day operations and continues to implement the value-add plan. Finally, Act 5 is the exit. After a predetermined period, usually somewhere between 3 and 7 years, the business plan is complete. The property is renovated, stabilized, fully leased at higher market rents, and is now worth significantly more than what the fund paid for it. The sponsor then sells the property. This sale is the major liquidity event, the big payday. The proceeds from the sale are used to pay off the mortgage and any remaining expenses. The initial capital that all the LPs invested is returned to them, and the profits that are left over are then split between the general partner and all the limited partners according to a prearranged structure. This is where you realize the bulk of your return on investment, the reward for your patience and trust in the sponsor's plan. This 5-act structure, raise, acquire, improve, operate, and exit, is the fundamental life cycle of most private real estate funds. It's a proven model for taking an underperforming asset and transforming it into a high-performing, profitable investment. It allows you to be part of a massive, complex, and highly lucrative project, all from a passive position. So now you understand the blueprint. You see how pooling money, leveraging expert operators, and using a protective legal structure allows you to own a piece of something massive. But here's the critical thing you need to understand next. Not all funds are built the same. They don't all follow the exact same strategy or carry the same level of risk. Some real estate funds are like buying a brand new, reliable Toyota Camry, safe, stable, and designed to produce steady income. Others are like investing in a Formula One race car, high risk, high octane, and built for explosive growth. Understanding the difference is absolutely essential to choosing the right investment for you. And that's exactly what we're going to break down next. So let's pop the hood on these two vehicles, the debt fund and the equity fund, and see what really makes them tick. Because on the surface, they both involve real estate, but underneath, their engines, their fuel, and their destinations are worlds apart. First, let's talk about the debt fund, our reliable family sedan. When you invest in a real estate debt fund, you are not buying property. Let me repeat that because it's the most important distinction. You are not buying a piece of the building. Instead, you are becoming the bank. You, along with the other investors in the fund, are lending money to a real estate developer or investor who needs capital to buy or build a property. Your investment is a loan secured by the real estate itself. Think about it like your own home mortgage, but you're on the other side of the table. The bank gave you a loan to buy your house. In a debt fund, you are the bank. The fund pools your money and makes loans to dozens, maybe hundreds of different real estate projects. And how do you make money? The same way the bank does, interest. The borrowers make regular, scheduled interest payments to the fund, and the fund then passes those profits on to you, the investor. It's a cash flow machine. It's designed for consistency. The goal isn't to hit a grand slam. The goal is to get every single inning, and win the game through relentless, predictable performance. Now, what about the risk? If you're the bank, your biggest fear is the borrower not paying you back, a default. This is where the true power of a debt fund lies. Your loan is secured by a hard asset, the property. This is called collateral. If the borrower defaults, the fund can foreclose on the property and sell it to get its money back. And here's the crucial part. As the lender, you are in what's called the first lien position. This is a fancy legal term that means you are first in line to get paid. Before the owners, before any other junior lenders, you get your money back first. This provides a massive layer of protection. Debt funds typically only lend up to a certain percentage of the property's value, say 65 or 75%. This creates a built-in equity cushion. Even if the property value drops by 20%, there's still more than enough value to pay back your loan in full. So the debt fund is for the investor who prioritizes capital preservation and predictable income. It's for the person who wants their investment to work like a high-yield savings account on steroids, kicking off consistent cash flow month after month, without the drama of the stock market. Okay, buckle up. Let's get out of the sedan and climb into the cockpit of the Formula One race car. The equity fund. When you invest in a real estate equity fund, you are doing the exact opposite of a debt fund. You are not the bank. You are the owner. You are buying a direct ownership stake in the properties themselves. Your money is pooled with other investors to purchase the down payment, the equity in a building or a portfolio of buildings. You and your fellow investors are now the landlords. You own the asset. So how do you make money here? Comes from two primary sources, and this is key. First, there's cash flow from operations. After the fund collects all the rent from tenants and pays all the bills, the mortgage to the bank, the property taxes, the insurance, the maintenance, whatever is left over is profit. That profit can be distributed to you, the owner. This is similar to a dividend from a stock. But the real adrenaline-pumping, life-changing money in equity funds comes from the second source: appreciation. This is the big one. This is the reason you get in the race car. The fund's strategy is to buy a property, increase its value over time, either through renovations, better management, or just market growth, and then sell it a few years later for a massive profit. When that sale happens, after the bank loan is paid off, all the remaining profit is split among the owners, the equity investors. This is where you see those incredible returns, the 2x, 3x, even 5x multiples on your initial investment. You put in $100,000 and 5 years later you could get back $300,000. That's the grand slam. That's winning the championship. But what about the risk? It is substantially higher. Remember that first lien position we talked about with debt funds? Well, as an equity owner, you are in the last position. If the project goes south and the property has to be sold at a loss, the bank gets paid first. If there's nothing left after the bank is made whole, the equity investors are completely wiped out. Your entire investment could go to zero. The cash flow isn't guaranteed either. If a major tenant leaves or an unexpected, expensive repair comes up, the profits can vanish overnight. You are taking on the full risk of ownership, but you are also positioned to reap the full rewards of success. So let's put it all on the table in a simple side-by-side comparison. Your role. In a debt fund, you're the lender. In an equity fund, you're the owner. How you're paid. In a debt fund, through fixed interest payments. In an equity fund, through rental profits and appreciation. The risk. In a debt fund, it's lower, protected by collateral and first lien position. In an equity fund, it's higher as you are last in line to get paid. The potential return. In a debt fund, it's steady and capped. You'll never get more than your agreed upon interest rate. In an equity fund, the potential is theoretically unlimited. Let's use a real-world example to drive this home. Imagine a fund wants to buy a $10 million apartment building. They go to a bank or a debt fund and get a loan for $7 million. The remaining $3 million is the down payment, the equity which they raise from investors. If you invest in the debt portion of this deal, you are part of that $7 million loan. You might earn a fixed 8% annual return on your money. So if you invested $100,000, you'd get $8,000 a year. Predictable. Simple. Now let's say 5 years later, the building's value has skyrocketed, and it sells for $15 million. Do you get any of that extra profit? No. You get your original $100,000 back, plus the interest you were owed. Your job is done. You were the bank. But if you invested in the equity portion, you are part of that $3 million down payment. Let's say you also put in $100,000, which buys you a 3.33% ownership stake in the project. For 5 years, you collect your share of the rental profits. Then the building sells for $15 million. First, the $7 million bank loan gets paid off. That leaves $8 million in profit. Your 3.33% share of that is over $266,000. Your initial $100,000 investment more than doubled, on top of any cash flow you received along the way. That's the explosive power of equity. But flip the scenario. What if the market crashes and the building only sells for $7 million? The bank gets its $7 million back. And the equity investors? They get nothing. They are completely wiped out. This is the fundamental choice you have to make. Are you playing for steady, reliable income? Or are you swinging for the fences, hoping for a home run? Are you building a portfolio that helps you sleep at night, or one that could potentially change your life? The sedan or the F1 car? Answering that question is the first, most critical step. But choosing your vehicle, debt or equity, is only half the battle. Because within the world of equity funds, there are different types of race cars. Some are designed for steady endurance races, while others are built for explosive, high-risk sprints. The next, and arguably more important step, is understanding the specific strategies these funds use to generate returns. How do they actually take a property and increase its value? We're about to pull back the curtain on the 4 core real estate fund strategies, from the safest and most conservative to the most aggressive and speculative. Getting this part right is the difference between cruising to the finish line and spinning out on the first turn. Alright, let's pull back the curtain, starting with the bedrock, the foundation of real estate investing. This is the core strategy. Think of a core fund as the real estate equivalent of a blue-chip stock like Coca-Cola or Johnson & Johnson. It's not designed to give you a heart attack with wild swings. It's designed to help you sleep at night. These funds invest in the highest quality, most stable, and most desirable properties in the best locations. We're talking about a brand new fully leased Class A office tower in downtown Manhattan, a luxury apartment building in a prime neighborhood of San Francisco, where there's a waiting list to get in, a grocery-anchored shopping center with a 20-year lease from a major chain like Whole Foods. These are what we call stabilized assets. There's no guesswork here. The tenants are in place, the rent checks are coming in every month like clockwork, and the buildings are pristine. The goal of a core strategy is not to hit a home run. It's to hit singles and doubles consistently, year after year. The primary source of return is income, the cash flow generated from rent. Appreciation, or the property's value going up, is just the cherry on top. Because the risk is so low, the leverage or the amount of debt used is also very low, typically less than 40% of the property's value. This is the strategy favored by massive institutional investors like pension funds and insurance companies. They're not looking for a lottery ticket. They're looking for predictable, reliable cash flow to meet their obligations for decades to come. For an individual investor, this is the slow and steady wealth compounder. The expected returns reflect this low-risk profile, typically in the 7 to 10% range annually. It's a defensive play, built to weather economic storms. But what if you want a little more? What if you're willing to take on just a touch more risk for a bit more reward, without straying too far from safety? That's where we take one step up the ladder to the Core Plus strategy. The name says it all. It's core, with a plus. These funds still invest in high-quality, well-occupied properties, but they look for assets with a small, identifiable problem that can be fixed to boost income. Think of it like buying a great house in a great neighborhood that just has an outdated kitchen from the 1990s. The bones are good, the location is perfect, but with a small targeted investment, new countertops, stainless steel appliances, you can significantly increase the rent and the property's value. In the world of commercial real estate, this might be a Class A office building that's 95% leased, but the lobby feels a bit dated. The Core Plus fund manager comes in, renovates the lobby, adds a modern coffee bar and some co-working space, and can now justify raising the rents for all tenants upon renewal. Or maybe it's a solid apartment complex where the rents are slightly below market rate. The manager can implement a light renovation program, upgrading units as tenants move out, and then release them at the higher market rate. The key here is that the enhancements are minor. We're not gutting the building. We're making small strategic improvements to an already high-quality asset. The risk is still low, but it's slightly higher than pure core because there's some execution involved. The plan has to work. As a result, the leverage is a bit higher, maybe in the 40 to 60% range, and the target returns tick up accordingly, usually aiming for 9 to 12%. It's a strategy for investors who want the stability of core, but with an added little kick of growth potential. Now we're moving into territory where the real transformation happens. This is where fund managers go from being caretakers to being creators. Welcome to the value-add strategy. If core is buying a finished masterpiece, value-add is buying a rough diamond and cutting it into a brilliant jewel. These funds specifically target properties that have a significant problem, a problem that scares away less experienced investors. This could be a high vacancy rate, deferred maintenance, poor management, or the need for a major renovation. Think of an older apartment building from the 70s in a neighborhood that's rapidly improving. It has shag carpets, old appliances, and it's only 60% occupied because the previous owner just let it go. A value-add fund sees the potential. They buy it at a discount, they completely gut and renovate every single unit, they add a new gym, a rooftop deck, rebrand the entire building, and bring in professional management to lease it up at significantly higher rents. They are literally creating value where it didn't exist before. Another example could be an old, half-empty office building. A value-add fund might come in, modernize the entire infrastructure, and reposition it to attract high-growth tech tenants who are willing to pay a premium for cool, modern space. This is the real estate equivalent of the show Flip or Flop, but on a massive multi-million-dollar scale. The risk here is considerably higher. The renovation could go over budget. The lease-up could take longer than expected. The business plan is much more complex than just collecting rent checks. Because of this, the reliance on debt is higher, with leverage often climbing into the 60 to 75% range. And the returns? They have to compensate for that risk. Value-add funds typically target returns of 12 to 18%, with a much larger portion of that return coming from appreciation, the forced increase in the property's value, rather than initial cash flow. In fact, cash flow might be low or even negative during the renovation period. This is a strategy for investors with a higher risk tolerance, who are looking for capital growth and are willing to wait a few years to see the business plan fully executed. Finally, we arrive at the top of the pyramid, the highest risk and the highest potential reward. This is the opportunistic strategy. If value-add is renovating the house, opportunistic is buying the empty lot and building the house from scratch. Or it's taking an old warehouse and turning it into a luxury hotel. This strategy is not about fixing existing problems. It's about capitalizing on major market trends and creating something entirely new. Opportunistic funds engage in ground-up development, complex redevelopments, or investing in niche property types or emerging markets that are not yet proven. Imagine a fund manager in 2010 who foresaw the explosion of e-commerce and started buying up land near major highways to build massive, state-of-the-art logistics and distribution centers for companies like Amazon. At the time, it was a huge gamble. Today, it looks like genius. That's an opportunistic play. They are betting on the future. They might buy a portfolio of distressed loans from a bank, or acquire a company that owns a lot of real estate. They operate where complexity and uncertainty are at their highest. There is no existing cash flow to rely on. In fact, these projects require massive capital infusions for years before they ever generate a single dollar of revenue. The risk of failure is real. A development project can get bogged down in zoning and permit battles. Construction costs can spiral out of control. An economic downturn can hit right when the project is finished, making it impossible to lease up. To pull this off, managers use the highest levels of leverage, often 70% or more. The payoff for taking on this monumental risk has to be equally monumental. Opportunistic funds are swinging for the fences, targeting returns of 18% and above. This is the venture capital of the real estate world. It's for the most sophisticated investors who understand the risks and are seeking outsized, equity-like returns from their real estate allocation. So you have core, core plus, value add, and opportunistic. 4 distinct playbooks on a spectrum from defense to offense, from income to growth, from low risk to high risk. Understanding which game you want to play is the first and most critical step. But knowing the strategy is only half the battle. The other half is understanding the vehicle you're riding in. Is the fund structured to let you get your money out when you want, or is it locked up for a decade? Is it a public company you can buy on the stock market, or a private club for the ultra-wealthy? The structure of the fund is just as important as the strategy, and getting that wrong can be a painful and costly mistake. So how do you tell the difference? How do you know if you're signing up for a 10-year voyage across the ocean or just hopping on a ferry to the other side of the bay? It all comes down to 2 fundamental forks in the road that every single real estate fund must take. And your job as an investor is to know which path they chose. The first fork in the road is the question of time. Is the fund open-end or closed-end? Let's start with closed-end. Imagine you're funding an expedition to build a new city from scratch in the middle of the desert. You gather a group of visionary investors, they all put their money into a giant pot, and you say, great, we'll see you in 10 years when the city is built and thriving. The doors are now locked. No one else can join, and no one can leave. That is a closed-end fund. It has a specific, finite lifespan. It raises a set amount of capital at the beginning, invests it according to its plan, and then at the end of the term, say 7 to 10 years, it sells off the assets and distributes the profits back to the original investors. The capital is locked up for the duration. Now, why on earth would anyone agree to this? Because the strategy demands it. You can't build a skyscraper, redevelop an entire neighborhood, or turn a failing hotel into a luxury resort if your investors can pull their money out halfway through construction. These value-add and opportunistic strategies, the ones that promise the highest returns, require patience and long-term commitment. The closed-end structure provides the fund manager with a stable, predictable pool of capital to execute these complex, multi-year business plans without worrying about panicked investors demanding their cash back during a market downturn. It's the structure of choice for transformation. On the other side of the fork, you have open-end funds. Think of these less like a one-time expedition and more like a luxury hotel with a revolving door. Investors can check in and check out on a regular basis, usually monthly or quarterly. The fund doesn't have a set expiration date. It exists in perpetuity, constantly buying and selling assets and accepting new capital or returning it to existing investors. When you invest, you buy shares at the fund's current net asset value or NAV, which is just a fancy term for the total value of all its properties minus any debt. When you want to leave, you redeem your shares at the newly calculated NAV. This structure is perfect for core and core plus strategies. These funds typically own stable, high-quality, income-producing properties like fully leased office buildings in major cities, or a portfolio of grocery-anchored shopping centers. The goal isn't dramatic transformation. It's steady income and gradual appreciation. Because the assets are stable and generate predictable cash flow, the fund can handle investors coming and going. The manager's job is to maintain a high-quality portfolio while keeping enough cash on hand to honor redemption requests. It offers investors liquidity, not daily like a stock, but a predictable opportunity to exit, which is a world away from a 10-year lockup. So closed-end is for building the new city. Open-end is for owning and managing the best parts of a city that's already built. One isn't inherently better than the other. But choosing the wrong one for your personal financial timeline can be catastrophic. If you think you might need your cash back in 3 years for a down payment on a house, investing in a 10-year closed-end fund is financial suicide. That's the first fork in the road time. The second is about access. Is the fund public or private? Let's start with public. This is the world most of us are familiar with. The most common type of public real estate fund is a REIT, a real estate investment trust, that is publicly traded on a stock exchange like the New York Stock Exchange. You can buy and sell shares of a company like Prologis, which owns warehouses all over the world, or Simon Property Group, which owns shopping malls, just as easily as you can buy a share of Apple or Tesla. You log into your brokerage account, you click buy, and you're done. You're a real estate investor. The beauty of a publicly traded REIT is what we call liquidity. You can sell your shares any second the market is open. The minimum investment is just the price of a single share. And because they are public companies regulated by the Securities and Exchange Commission, or SEC, they have to disclose an enormous amount of information. Their financials, their property portfolio, their management team. It's all out there for you to see. The trade-off? Their stock price can be just as volatile as any other stock. The value can swing wildly based on Federal Reserve announcements or general market panic, sometimes completely disconnected from the actual, underlying value of the real estate they own. Now let's walk across the street to the other side. The world of private funds. This is the private club for the ultra-wealthy we hinted at before. These funds are not traded on a public exchange. You can't find them on your Schwab or Fidelity account. Instead, they are offered directly to a select group of investors through what's called a private placement. And to get an invitation to this club, you almost always need to be an accredited investor. This is one of the most important and misunderstood terms in American finance. So what is it? The SEC has a clear definition. To be an accredited investor as an individual, you need to meet one of two tests. The income test. You must have an annual income of over $200,000 or $300,000 with your spouse for the last 2 years, with the expectation of earning the same in the current year. Or the net worth test. You must have a net worth of over $1 million, either alone or with a spouse, and this is a key detail. That calculation excludes the value of your primary residence. Why does this rule exist? Is it just to keep regular people out of the best deals? The official reason is investor protection. The SEC's logic is that private investments are riskier, more complex, and far less transparent than public ones. There's no public stock price, there's less mandatory disclosure, and your money is almost always locked up for years. The government essentially says, if you don't have a certain level of financial cushion, a high income or a high net worth, we don't think you're sophisticated enough to understand these risks, or wealthy enough to absorb a total loss. It's a government-mandated gatekeeper, designed to prevent people from losing their life savings on a speculative, illiquid investment they don't understand. So, when you combine these two forks in the road, you get a matrix of possibilities. You can have a public open-end fund. You can have a private closed-end fund. This is the classic private equity real estate model, raising money from accredited investors for a 10-year value-add project. You can even have a private, open-end fund, often catering to high-net-worth families who want steady income and quarterly liquidity without the volatility of the stock market. The structure is not just administrative paperwork. It is the fundamental operating system of the fund. It dictates who can invest, how they invest, and when or if they can get their money back. An opportunistic fund manager trying to develop a new beachfront resort needs the ironclad commitment of a closed-end structure. A core fund manager holding a portfolio of Amazon distribution centers can offer the flexibility of an open-end structure. The strategy and the structure must be in perfect alignment. For you, the investor, understanding this is everything. It tells you what doors are even open to you. If you're not an accredited investor, the world of private funds is largely closed off. It defines your liquidity, which is just as important as your potential return. A 20% return in a fund you can't touch for a decade is useless if you have a financial emergency in year 3. It sets your expectations for risk and transparency. Public means liquidity and information, but also market volatility. Private means illiquidity and less transparency, but the potential for higher returns insulated from the daily whims of the stock market. Getting this wrong is like packing for a beach vacation and ending up on an expedition to Antarctica. Both can be great trips, but not if you brought the wrong gear. You have to match the fund structure to your own personal financial needs, your timeline, and your tolerance for risk. So now you get it. You found a fund with a strategy that excites you. Let's say it's value-add multifamily, and you've confirmed its structure fits your life. It's a private, closed-end fund, and you're an accredited investor with a long-term mindset. You're ready to invest. But before you write that check, there's one more critical piece of the puzzle. What is this going to cost you? Because in the world of real estate funds, the fees are where the devil hides in the details. They can be the silent killer of your returns. There's a classic model, a secret handshake of sorts in the private fund world, known simply as 2 and 20. And understanding precisely how it works is the difference between you building significant wealth and you simply making the fund manager incredibly wealthy. Let's break down this 2 and 20 model, because it's the engine that drives the entire private real estate fund world. It sounds complex, but at its core, it's just a compensation structure designed to do two things: keep the fund's lights on and incentivize the manager to make you a lot of money. The name itself gives you the formula: 2% and 20%. First, the 2. This refers to the annual management fee. Think of this as the subscription fee for having a team of experts manage your capital. Typically, this is a 2% fee calculated on the total amount of money the fund manages, what the industry calls assets under management, or AUM. So if a fund raises $100 million from investors, a 2% management fee means the fund management company receives $2 million per year, every single year. Now, it's critical to understand this, that $2 million is paid whether the fund is knocking it out of the park or striking out completely. It's the cost of doing business. This fee covers the immense operational overhead of running a sophisticated real estate operation. We're talking about salaries for a team of analysts, acquisition specialists, asset managers, accountants, and lawyers. It pays for the office lease, the expensive data subscriptions, the marketing to find deals, the legal costs for setting up entities, and the travel expenses for flying out to inspect properties. The management fee is what allows the fund to exist and operate on a daily basis. But you can immediately see the potential conflict, right? This fee is a direct drag on your returns. Before your investment has made a single dollar in profit, it's already down 2% for the year just from this fee. That's why, as an investor, you need to scrutinize it. While 2% is a traditional benchmark, you'll often see variations. A larger, more established fund might command 2%, while a newer fund or one with a simpler strategy might only charge 1% or 1.5%. This fee is a fixed hurdle your investment has to clear every year just to break even. But it's the second number, the 20, where the real magic and the real money is made. The 20 refers to the performance fee, also known as carried interest. This is the fund manager's share of the profits. And this is what truly aligns their interests with yours. The manager doesn't get this 20% automatically. They only get it after you, the investor, have received a predetermined minimum level of return. This minimum level is called the preferred return, or the hurdle rate. Think of it like this: you tell the fund manager, "Look, I'm giving you my capital. I expect to earn at least an 8% return on my money each year before you get to take a big slice of the profits for yourself." That 8% is the preferred return. It's the hurdle they have to clear. Only on the profits above that 8% hurdle does the manager get to participate. This ensures the manager isn't getting rich off mediocre performance. They only get their big payday if they deliver outstanding results for their investors. Let's walk through a crystal clear example. Imagine you invest in that same $100 million fund. The terms are 2 and 20, with an 8% preferred return. Scenario 1. The fund has a good year and generates a 12% total return. That's $12 million in profit. How is that cash divided? The first thing that happens is the preferred return is paid out. Investors are owed the first 8% of their capital. 8% of $100 million is $8 million. So, the first $8 million of that profit goes straight to the investors. Now there's $4 million of profit left over. This is the profit above the hurdle. This is where the 20% performance fee kicks in. The fund manager gets 20% of that remaining $4 million, which is $800,000. The other 80%, which is $3.2 million, goes to you and the other investors. So in total for the year, investors receive their $8 million preferred return plus their $3.2 million split, for a total of $11.2 million. The manager got their $800,000 performance bonus. Everyone wins. Scenario 2. The fund has a phenomenal year. They hit a home run and generate a 30% return. That's $30 million in profit. The math is the same. First, investors get their 8% preferred return, which is $8 million. That leaves $22 million in profit above the hurdle. The manager now gets 20% of that $22 million, which is a whopping $4.4 million. The investors get the other 80%, which is $17.6 million. So the investors' total take is their $8 million pref plus $17.6 million, for a total of $25.6 million. The manager is handsomely rewarded for delivering exceptional returns, and the investors are made incredibly wealthy. This is the alignment of interests in its most perfect form. But what happens if the fund has a bad year? Let's say it only generates a 5% return, or $5 million in profit. The preferred return hurdle is 8%. Since the fund didn't even clear the hurdle, the manager gets zero performance fee. That entire $5 million in profit goes directly to the investors to help them get closer to their 8% preferred return. The manager still collects their 2% management fee to keep the lights on, but their big bonus is completely off the table. This entire sequence of how money is paid out is called a distribution waterfall. Picture a series of buckets, one on top of the other. All the profit pours into the very top bucket. This first bucket is the preferred return. It fills up until the investors have received their 8%. Once it's full, the profit overflows into the next bucket down. This second bucket is where the 20% split, the carried interest, happens. But here's a pro-level detail you have to watch out for. Something often buried in the fine print that can make a massive difference in your returns. It's a clause called the catch-up. A catch-up provision is incredibly favorable to the fund manager. It changes the waterfall structure slightly. In a fund with a catch-up, after you get your 8% preferred return, the next slice of profits goes 100% to the fund manager, until they have caught up to a full 20% of all profits distributed so far. Let's revisit our first scenario, the 12% return, or $12 million profit. Investors get their $8 million preferred return first. Now with a catch-up clause, the manager needs to catch up. The goal is a final 80-20 split of all profits. If the investors got $8 million, which is their 80% share, what would the manager's 20% share be? It would be $2 million. So, under a catch-up clause, the next $2 million in profit goes 100% to the manager. In this case, the first $8 million goes to investors, the next $2 million goes to the manager, and the remaining $2 million is then split 80-20. So the manager would get an additional $1.6 million, 80% of $2 million, and the investors would get an additional $400,000, 20% of $2 million. Wait, let me rephrase that. Let me make that simpler. Let's try that catch-up example again. A 12% return, $12 million profit. Bucket 1. Investors get their $8 million preferred return. Now we have $4 million left. With the catch-up, the manager is entitled to a 20% share of total distributed profits. To calculate their catch-up amount, you take the investor pref, $8 million, divide it by the investor's share, 80% or 0.8, and then multiply by the manager's share, 20% or 0.2. So, $8 million divided by 0.8 is $10 million. Multiply that by 0.2 and you get $2 million. That means the next bucket, the catch-up bucket, gives the manager 100% of the profits until they receive $2 million. In our example, we have $4 million left after the pref, so the manager easily gets their $2 million catch-up. Now we have $2 million left over, which spills into the final bucket, where it's split 80-20. Investors get 80% of that $2 million, $1.6 million, and the manager gets 20%, $400,000. So the final tally with the catch-up is, investors get their $8 million pref plus $1.6 million from the final split, for a total of $9.6 million. The manager gets their $2 million from the catch-up plus $400,000 from the final split, for a total of $2.4 million. Without the catch-up, the manager only made $800,000 on that same deal. With the catch-up, they made 3 times as much. It's a subtle but powerful mechanism. Understanding this waterfall, the preferred return, the potential catch-up, and the final carried interest split, is non-negotiable. This is the rulebook for how you get paid. It dictates the flow of every single dollar of profit. And knowing how to read this rulebook is what separates amateur investors from the pros. But this brings up a crucial question. We've talked about how profits are split, but how are those profits actually generated and, more importantly, how do they get from the fund's bank account into yours? What does an actual exit look like, and how long is your money tied up before you see a dime of it? That process of turning a property into cold, hard cash is the next critical piece of the puzzle. So, you've invested your money. You've signed the documents. The fund has acquired a property. Now comes the most important part of the entire equation: getting paid. The journey of a dollar from a tenant's rent check, through the fund's complex structure, and finally into your bank account is one of the most misunderstood aspects of real estate fund investing. Let's demystify it, because this isn't just about making money. It's about understanding the mechanics of how your wealth is generated. There are fundamentally two ways you get paid from a real estate fund, and I like to think of them as the drip and the gush. First, let's talk about the drip. This is the steady, predictable flow of cash that comes from the property's day-to-day operations. Imagine our fund bought a 200-unit apartment complex. Every month, 200 tenants pay their rent. That money goes into the property's operating account. From that big pool of cash, the fund manager pays all the bills: the mortgage, property taxes, insurance, maintenance staff, landscaping, utility bills, marketing costs, everything it takes to run the property professionally. What's left over after all those expenses are paid is called the net operating income, or NOI. This is the pure profit the property generates each month. This profit is then typically distributed to the investors, usually on a quarterly basis. This is the drip. It's your share of the rental profits, dripping into your account every 3 months. It's not going to be a life-changing gusher of cash, but it's the lifeblood of the investment, providing a consistent return while the real magic is happening behind the scenes. Now, this is where a critical term comes into play: the preferred return. You'll see this in almost every fund's offering documents. It might say something like 8% preferred return. What does that mean? It's a powerful investor protection. It means that you, the investor, get the first cut of the profits up to that percentage. Think of it like a line at a buffet. The investors with a preferred return get to go to the front of the line. Before the fund manager can take their share of the profits, they have to make sure you've received your pref. So, if the fund has an 8% preferred return, the goal is to distribute enough cash flow from the rental income to pay you an 8% annualized return on your investment. If the property's cash flow in a given year is only enough to pay out 6%, that remaining 2% you're owed doesn't just disappear. It accrues, meaning it gets added to a running tab. The fund still owes you that 2%, and it must be paid out from future cash flow or from the proceeds of a future sale before the manager gets their big payday. This aligns their interests with yours. They are heavily incentivized to make sure the property performs well enough to hit that preferred return target. So the drip is great. It's the quarterly cash flow that proves the investment is healthy. But it's not where the big wealth is created. For that, we need the gush. The gush refers to a capital event. This is a major financial event where a large amount of capital is unlocked and distributed to investors. There are two primary types: a refinance or the final sale. Let's start with the refinance, because it's a brilliant strategy that sophisticated investors use. Let's go back to our 200-unit apartment complex. The fund bought it for $20 million. They used a bank loan for $15 million and raised $5 million from you and other investors. Over the next 2 to 3 years, they do exactly what they promised. They renovate the units, add a new gym, improve the landscaping, and bring in better management. Because the property is now a nicer place to live, they can raise the rents. The property is now generating significantly more income than it was before. Because its income is higher, the property's value has shot up. It's no longer a $20 million property. An independent appraiser now says it's worth $30 million. This is what's known as forced appreciation. The fund didn't just wait for the market to go up. They actively forced the value higher. Now the fund manager goes to a new bank and says, "Look at this amazing, high-performing asset now worth $30 million. We'd like to get a new, larger loan on it." The new bank agrees and gives them a new loan for, say, $22 million. What happens next is the magic. The fund takes that $22 million and first they pay off the original $15 million loan. That leaves them with $7 million in cash. Where does that cash go? It gets distributed directly to the investors. This is a gush. It's a massive tax-free return of your capital. If you invested $100,000, you might get $70,000, $80,000, or even all $100,000 of your initial investment back from this single refinance event. But here's the beautiful part. You still own your full share of the property. You've gotten your money back, but you continue to own the asset and continue to receive your share of the ongoing cash flow, the drip. You're now playing with the house's money. The second and final type of gush is the sale. This is the ultimate exit strategy. After, say, 5 to 7 years, the business plan is complete. The property has been stabilized at its new higher value. The fund manager decides it's the right time to sell. They put the property on the market and sell it for that $30 million valuation. When the sale closes, a cascade of events happens. This is called the distribution waterfall for a reason. The money flows down in a very specific order, filling one bucket before spilling over into the next. Bucket number 1 is paying off any remaining debt. Let's say after the refinance we still had that $22 million loan. That gets paid off first. So $30 million minus $22 million leaves $8 million in profit. Bucket number 2 is the return of any remaining investor capital. In our refinance example, we returned a lot of capital already. But let's say there's still some of your initial investment left in the deal. That comes back to you now. The fund's primary duty is to return your principal first. Bucket number 3 is paying out any accrued, unpaid preferred return. Remember that 2% we said was on the running tab from a slow year? It gets paid out here from the sale profits before anyone else sees another dime. Once all the investors have gotten all their initial capital back and have been paid their entire preferred return for the life of the investment, only then does the final bucket get filled. This is the profit split, often called the promote or carried interest. This is where the fund manager finally gets their big reward. The remaining profit is split between the investors and the manager according to a predetermined ratio, commonly 70/30ths or 80/20ths. That means 70 or 80% of the profit goes to you, the investors, and 20 or 30% goes to the manager. This waterfall structure is the bedrock of a well-structured fund. It ensures that the investors get their capital back first, then they get their preferred return, and only after those two hurdles are cleared does the manager share in the upside. It's the ultimate alignment of interests. The manager only makes serious money if you make serious money first. So what does this mean for the timeline? This is not a stock you can sell tomorrow. When you invest in a private real estate fund, your money is typically locked up for the duration of the fund's business plan, which is usually projected to be 3, 5, or even 7 years. You are trading liquidity for a higher potential return. You can't just call up the manager in year 2 and ask for your money back. The capital is tied up in a physical asset. You get your money back through the drip of quarterly distributions and through the gush of capital events like a refinance or the final sale. This illiquidity is a feature, not a bug. It allows the fund manager to execute their long-term strategy without worrying about daily market fluctuations or investors panic selling. They can focus purely on maximizing the value of the property, which is ultimately what generates your returns. The process is a marathon, not a sprint. It's a carefully orchestrated sequence of value creation, cash flow, and strategic exits. But understanding how you get paid is only half the battle. The next and arguably more important question is, how do you know if you're actually making good money? A fund might promise an 18% return, but what does that even mean? How is that number calculated? And how can you compare one fund's performance against another? We need to talk about the key metrics that separate the amateurs from the pros. Things like the internal rate of return, the cash-on-cash return, and the equity multiple. These are the numbers that truly tell the story of your investment's performance. And learning how to read them is like being handed the secret decoder ring to real estate investing. But that decoder ring only tells you what the numbers are saying. It doesn't tell you who wrote the message. And in real estate, the who is everything. Before you even think about IRR or equity multiples, you have to do something far more important. You have to underwrite the sponsor. You are not investing in a spreadsheet. You are not investing in a building. You are investing in a team of people. Their judgment, their integrity, and their experience will be the single greatest determinant of your success or failure. So how do you vet a sponsor? First, you look at their track record. And I don't mean the glossy brochure showing their 3 biggest home runs. I mean their full track record. You need to ask for a list of every deal they've ever done, the good, the bad, and the ugly. A great sponsor isn't one who has never lost money. A great sponsor is one who has navigated a downturn, like 2008, and lived to tell the tale. They learned from their mistakes, protected their investors' capital as best they could, and came out smarter on the other side. A sponsor who has only operated in the last decade of up and to the right markets has never truly been tested. Their strategy might work when everything is easy, but what happens when the tide goes out? You want a captain who has sailed through a hurricane, not just on a calm lake. Next, look for alignment of interests. The fanciest term for this is co-investment, but the simple term is skin in the game. How much of their own, personal, hard-earned cash is the sponsor putting into this fund alongside you? If a sponsor is asking you to invest $100,000, but they're only putting in $10,000 of their own, how aligned are they really? Their downside is tiny. Your downside is huge. You want to see a significant co-investment, typically between 5 and 10% of the total equity raised. When the sponsor has a meaningful amount of their own net worth on the line, you can be sure they will fight tooth and nail to protect that capital, which means they're fighting to protect yours too. Their sleepless nights become your peace of mind. And finally, on the sponsor, test their transparency. Before you invest a dime, how do they communicate? Are they responsive? Do they answer your tough questions directly? Or do they give you the runaround? Ask for references and not just a curated list of their happiest investors. Ask to speak to an investor from a deal that didn't go as planned. How did the sponsor handle the bad news? Did they communicate proactively? Did they take responsibility? A sponsor who is a ghost before you write a check will be a black hole when problems arise. And in real estate, problems always arise. Once you're comfortable with the people, it's time to scrutinize their plan. This is the fund's strategy. Is it laser-focused or all over the map? A fund that says, "We buy undervalued real estate anywhere in the US," is a massive red flag. That's not a strategy, it's a vague wish. A strong strategy is specific. For example, we acquire B-class, garden-style apartment buildings built between 1980 and 2000, located in the suburbs of Dallas, Austin, and San Antonio. Our business plan is to implement a $5,000 per unit renovation program to modernize interiors, improve amenities, and then increase rents by 15% over 3 years. See the difference? That is a clear, repeatable, and verifiable plan. It tells you they have expertise in a specific niche, a specific market, and a specific business model. You can then do your own research. Is there demand for renovated apartments in Dallas suburbs? Are 15% rent increases realistic in that market? A well-defined strategy allows you to independently verify their assumptions. A vague one forces you to trust them blindly. You also need to dig into their debt strategy. How are they financing these properties? Debt is like a power tool. It can help you build wealth faster, but it can also cut your arm off if you're not careful. Are they using conservative, long-term, fixed-rate debt? This is generally safer. The interest rate is locked in, so even if the market goes crazy, their mortgage payment stays the same. Or are they using short-term, floating-rate debt? This can be much riskier. If interest rates spike, their payments could skyrocket, potentially wiping out all the cash flow and even threatening the property with foreclosure. In a volatile interest rate environment, a fund's approach to debt can be the difference between solid returns and a total loss. Now for the part that makes most people's eyes glaze over. But it's where fortunes are protected or lost. The legal documents. You'll be sent a thick document called a Private Placement Memorandum, or PPM. Most people skip straight to the signature page. Don't. The most important section is called Risk Factors. The lawyers are legally required to list every conceivable thing that could go wrong. It's their CY, but it's also your roadmap of potential landmines. It will tell you about market risks, leverage risks, and sponsor-specific risks. Read every single one. Inside the PPM and the operating agreement, you'll find the fee structure. This is critical. Sponsors deserve to be paid for their expertise and hard work, but some fee structures are fair, and others are predatory. You'll see things like an acquisition fee, which is a percentage they take for buying the property, an asset management fee, an ongoing annual fee based on the property's value or the equity invested, and a disposition fee, a percentage they take for selling the property. Add them all up. Do they seem reasonable? If the fees are too high, the sponsor can make a handsome profit even if you, the investor, barely break even. The best structures incentivize the sponsor to make you money. And that brings us to the most important concept in the documents, the waterfall. Sounds complex, but it's just the order in which money flows back out of the deal. It determines who gets paid when. A common, investor-friendly structure is a preferred return. Let's say the fund offers an 8% preferred return. This means the investors get 100% of the profits until they have received an 8% annual return on their investment. Only after you've hit that benchmark does the sponsor start to share in the remaining profits. This split is called the promote or carried interest. For example, after everyone gets their initial capital back, and after you've received your 8% preferred return, the remaining profits might be split 70-30, 70% to you and the other investors and 30% to the sponsor. This is a fair alignment. It ensures you get paid first. A red flag is a structure where the sponsor gets their big payday before you've even gotten all of your initial investment back. The waterfall dictates the entire economic alignment of the deal. You have to understand it. If you don't, you must find a qualified attorney or financial advisor who can review it for you. Don't ever sign a document you don't fully comprehend. So you see, evaluating a real estate fund is a three-legged stool. You need a great sponsor, a sound strategy, and fair documents. If any one of those legs is weak, the whole thing can collapse. Diligence isn't about flipping through a glossy pitch deck. It's about being a skeptic. It's about asking hard questions, reading the fine print, and understanding that you are forming a long-term partnership. This is the work that separates the savvy investor from the person who gets a painful lesson. It's the deep dive that ensures the numbers on the page have a chance of becoming numbers in your bank account. So let's talk about those pages. Because after you've vetted the jockey, it's time to vet the horse they want you to bet on. This is where we move from the handshake to the fine print. We're talking about the legal documents that govern the entire investment, and at the heart of it all is a beast called the Private Placement Memorandum, or the PPM. Now I know what you're thinking. A 100-page legal document filled with dense language designed by lawyers to be as unreadable as possible. And you're not wrong. It can be intimidating. But I'm going to tell you something that might be the most important piece of advice in this entire series. You absolutely must read it. Not skim it. Read it. Because the PPM is the rulebook. It is the binding contract between you and the fund sponsor. Everything they promised you on the phone, every glossy slide in their presentation, if it's not in the PPM, it doesn't exist. This document is the ultimate source of truth. Think of it as the owner's manual for your investment. You wouldn't buy a complex, expensive piece of machinery without reading the manual to understand how it works, what its limits are, and how it might break. Your capital is that machine. The PPM is that manual. And inside, there are a few critical sections you need to hunt for and understand completely. First, the investment strategy and business plan. This is the what and the how. The PPM will explicitly state the fund's objective. Are they a core fund buying stable, high-quality, fully leased properties for steady cash flow, kind of like buying a blue-chip stock? Or are they value-add, buying slightly distressed or underperforming properties with a plan to renovate and increase their value? Maybe they're opportunistic, which is the highest risk, highest potential reward category, often involving ground-up development or turning around a deeply troubled asset. There is no right or wrong strategy, but there is a right and wrong strategy for you. Does their plan match your risk tolerance and your financial goals? More importantly, does this specific strategy align with the sponsor's proven track record? If a sponsor built their reputation on buying and stabilizing Class B apartment buildings in Texas, and now they're pitching a fund to develop a luxury hotel in Miami, that's a major disconnect. You need to see a direct line between their past successes and their future plans. The business plan should give you the granular details. It's not enough to say, we'll increase value. How? Are they renovating kitchens and baths? Are they adding a dog park and a gym? Are they firing the incompetent management company and bringing in their own expert team? The plan needs to be specific, credible, and something you can clearly visualize. Next, you're going to flip to the section that 99% of people skip, the risk factors. This is, without a doubt, the most important section of the entire document. It's literally the sponsor's legal team telling you, point by point, every conceivable way you could lose every single dollar you invest. People skip it because it's scary, but you need to read it because it gives you an unfiltered look into the fund's biggest vulnerabilities. Is the primary risk a change in interest rates, which could make refinancing difficult? Is it a reliance on a single major tenant in a commercial building? Is it construction risk, with the potential for delays and cost overruns? Reading this section isn't about talking yourself out of the deal. It's about understanding the battlefield. It allows you to ask the sponsor pointed questions. I see here that a major risk is a downturn in the local economy. What have you done to mitigate that? What are your stress tests showing for occupancy and rent rates? A good sponsor will have thoughtful, data-backed answers. A bad sponsor will get defensive or dismissive. Their reaction tells you everything. All right, let's get into the part that directly impacts your wallet: the fees and the profit structure. This is where you see if the sponsor's interests are truly aligned with yours. First up, fees. Sponsors are running a business, and they deserve to be paid for their expertise and work. But fees must be transparent and reasonable. You'll typically see an acquisition fee, around 1 to 2% of the purchase price of a property, for finding and closing the deal. There's usually an ongoing asset management fee, maybe 1 to 2% of the invested capital or collected revenue, for overseeing the entire project. There could be others like property management fees if they manage in-house, or a disposition fee when they sell. What you're looking for are fees that are in line with industry standards. A red flag is fee stacking, where a sponsor charges multiple, overlapping fees for the same service, or fees that are excessively high, eating into your potential returns before the project even has a chance to succeed. The question to ask is this fee structure fair for the work being done? But the true test of alignment comes down to one of the most critical concepts in private real estate: the distribution waterfall. Sounds complex, but the analogy is simple. Imagine your profits are water, and you have a series of buckets set up on different levels. The water has to fill the top bucket completely before it can spill over and start filling the next one. The very first bucket, the highest one, is always the return of capital. Before anyone sees a dime of profit, all of the investors get their initial investment back first. This is non-negotiable. Once that bucket is full, the water spills into the second bucket, the preferred return, or pref. This is a crucial feature for investor protection. It means that after you get your capital back, you are entitled to a certain percentage return, say 7% or 8% annually, on your investment before the sponsor starts to share in the profits. It's a hurdle they have to clear. If the fund only returns 6%, the sponsor might get nothing beyond their fees, because they didn't clear that 7% or 8% hurdle. This ensures you, the investor, get paid first. A low or non-existent preferred return is a massive red flag. Only after that second bucket, the preferred return, is full, does the water spill down to the next level. This is where the real profit sharing happens, and it's called the carried interest, or the promote. This is the sponsor's big incentive. A common structure is an 80-20 split. This means that for all profits generated above the preferred return, 80% goes to you and the other investors, and 20% goes to the sponsor. This is a beautiful alignment of interests. It incentivizes the sponsor to not just meet the preferred return, but to blow past it. Their big payday doesn't come from fees. It comes from hitting a home run for their investors. You should be happy for them to earn a handsome promote, because it means you've already gotten your capital back and earned a solid preferred return. You're both winning together. Finally, look for the sponsor's co-investment. How much of their own money are they putting into the deal right alongside yours? This is the ultimate skin in the game. A typical co-investment is between 5% and 10% of the total equity. If a sponsor is asking you to write a six-figure check, but they're only putting in a token amount of their own cash, you have to ask why. When the sponsor has a significant amount of their own net worth on the line, you can be sure they are going to work tirelessly to protect it, which means they're also protecting you. Reading the PPM isn't a legal exercise. It's an alignment exercise. You're checking the rules of the game to make sure it's a fair one. You're making sure the sponsor only gets rich if you do. This piece of paper, as boring as it seems, is the foundation of your entire investment. It contains all the risks, all the rules, and the entire recipe for how you're going to make money. Ignoring it isn't just lazy. It's a direct invitation for financial disaster. Understanding it is your final critical step of due diligence before you decide to move forward. So what exactly are you looking for in that private placement memorandum, that 100-page legal document that feels like it was designed to be unreadable? You're looking for one thing above all else: alignment. Is the entire deal structured so that the sponsor only makes serious money when you, the investor, make serious money? Or is it structured so they get paid no matter what happens? That is the billion-dollar question. Let's start with the fees. Every fund has fees. That's not the red flag. The red flag is the type of fees and when they get paid. You'll see things like an acquisition fee. This is a fee the sponsor charges for finding and buying the property. A typical fee might be 1% of the purchase price. It's standard. But if that fee is excessively high, say 3 or 4%, you have to ask why. They're getting a huge payday just for showing up, before they've created any value for you. A bigger red flag is a structure loaded with heavy upfront fees, but very little reward on the back end. You want a sponsor who eats what they kill. Their big payday should come from the profits they generate at the end of the deal, not from nickel-and-diming you along the way with a dozen different named fees. Next, you need to find the section on the distribution waterfall. This sounds complicated, but the concept is simple. It dictates the order in which money flows back out of the deal. The single most important feature here is the preferred return. A preferred return, or pref, is a hurdle that the sponsor must clear before they can start sharing in the profits. For example, a deal might have an 8% preferred return. This means that you, the investor, are entitled to the first 8% of the profits. The sponsor doesn't get to share in any of the upside until your capital has been returned, and you've received that 8% return. If a deal has a very low preferred return, or worse, no preferred return at all, you should run. Not walk. Run. It means the sponsor gets to share in the profits from day one, from the very first dollar of profit. There is absolutely no alignment there. A strong preferred return protects you. It ensures the sponsor is laser-focused on hitting a meaningful profit target before they get their big reward. Then, search that document for the sponsor co-invest. This tells you how much of their own personal cold hard cash the sponsor is putting into the deal alongside you. This is the ultimate form of alignment. It's their skin in the game. Think about it. If a sponsor is telling you this is the greatest deal since the invention of sliced bread, but they're only investing $1,000 of their own money while asking you for $100,000, what does that tell you? You want to see a significant co-investment. Typically, a good sponsor will invest anywhere from 5 to 10% of the total equity required. When their own family's capital is on the line, you can be sure they're going to treat that investment with the seriousness it deserves. Finally, look for conflicts of interest. Often, the sponsor will also own the property management company that manages the buildings, or the construction company that does the renovations. This is not automatically a bad thing. In fact, it can be very efficient. But it must be disclosed, and the fees they charge must be at or below market rate. The PPM should be crystal clear about these relationships. If it's buried in fine print or seems vague, that's a red flag. You need to know that they aren't overcharging the fund for services, which is just another way of taking money out of your pocket. Okay, so you've done it. You've vetted the team. You've dissected the strategy. You've read the PPM and confirmed the alignment is there. You've signed the documents and wired the funds. Now what? You sit back and wait for the private jet to show up, right? Not exactly. The journey after you invest is just as important as the one before. The first thing you need to understand is something called the J-curve. For the first year or two, your investment might actually show a paper loss. This is normal. Think about it, the fund just paid an acquisition fee. They're likely spending a lot of money on capital improvements to renovate the property. They're executing the business plan. Value is being created, but the financial statements might not reflect that immediately. Patience is not just a virtue in private real estate. It's a requirement. This isn't the stock market where you can check the price every 10 seconds. This is a long-term, illiquid investment. You have to trust the process you vetted. During this time, communication is everything. A good sponsor will not go dark on you. You should expect, at a minimum, quarterly reports. These reports shouldn't just be a single page with a number on it. They should be detailed. They should include updates on the renovation progress, occupancy rates, financial statements, and a narrative from the sponsor explaining what happened in the last quarter and what their focus is for the next one. This transparency is your window into the health of your investment. Then once a year you'll get a special document in the mail, the Schedule K1. This is the tax form that reports your share of the income, deductions, and credits from the partnership. Getting a K1 is a rite of passage. It feels complicated the first time you see it, but it's a sign that you are a true partner in a real asset. And one of the beautiful things about real estate is the tax benefits like depreciation, which will be passed through to you on that K1, potentially sheltering some of your cash flow from taxes. We started this journey with a simple question: what is a real estate fund? And the simple answer is that it's a partnership. It's a vehicle that allows a group of investors to pool their resources to buy assets they couldn't buy on their own. It offers the potential for diversification away from the volatile stock market, access to large-scale, professionally managed properties, and a way to generate passive income and long-term appreciation. But we've also learned that it's not a magic bullet. It comes with its own unique set of risks. Illiquidity, meaning your money is tied up for years. Complexity, requiring a deep level of due diligence. And most importantly, sponsor risk, where the success or failure of your investment rests squarely on the shoulders of the team you choose to partner with. We've covered how to find these deals, how to analyze the market and the strategy, how to tear apart a sponsor's track record, and how to read the legal documents to ensure your interests are protected. The goal was never to tell you what to invest in. It was to give you the framework, the mental models, and the checklist to make that decision for yourself confidently and intelligently. Investing in a real estate fund is about more than just financial returns. It's about owning a piece of the tangible world, a piece of an apartment building where families live, an office building where businesses grow, a warehouse that powers our economy. You're not buying a ticker symbol on a screen. You're buying a fractional interest in brick and mortar, in steel and glass. You're becoming part of the story of a community. This is a powerful tool for building generational wealth. But like any powerful tool, whether it's a scalpel or a sledgehammer, it demands respect. It demands education. It demands that you do the work. The knowledge you've gained here is your foundation. It's the starting point. Your journey to becoming a sophisticated, successful real estate investor doesn't end here. It's just beginning.